Hey, Small Axe community, it's your boy Nico. This show is dedicated to helping you use your small axe to build a personal empire. So, on this show, I'm going to share some real, raw, behind the scenes info that's going to help you build your own multifamily portfolio. So, if you enjoy this show, I would love it if you could share it with somebody that you think could get value from it and write a review. It's the only way that we can grow this thing. Now, let's get to work. Let's jump into this episode and start sharpening those axes. All right, fam, let's jump right into this episode. So the objective of today's episode is very simple. I want to provide you with an episode that you can share with those close to you to teach them about what multifamily real estate is. So today's episode is going to be as basic as I possibly can make it. And I'm actually struggling with figuring out how to portray this message to brand new investors. People that don't know anything about multifamily real estate, maybe are not even curious about it, or maybe are curious about it, but just want to learn a little bit more, don't have much time. So I'm going to try to make a quick 10-minute episode that you can literally share the link with somebody who is in your network so you could teach them a little bit about what you do. Typically, you guys, my audience, are active multifamily investors, meaning you are either trying to manage your own portfolio, grow your portfolio, or start your portfolio of multifamily real estate. So again, today's episode is simple. I want you to share this link with somebody to teach them about multifamily real estate. So you, as an active investor, you're always going to be looking for people to share the message with, to spread the word so that they can eventually learn what you do and then either do it themselves or invest alongside of you. So for those of you out there, so share this with somebody that you think could get value from it and that you think needs to hear this and to teach people. Now, for those of you out there who have never heard anything about multifamily real estate, you can buy apartment buildings. I don't know what's more exciting than that, but imagine owning an apartment building, okay? Pretty cool. So let's start with identifying or defining what multifamily real estate is. Multifamily real estate, commercial multifamily real estate, is 5 apartments or more. And you're going to hear me refer to apartments as units. So one apartment is 1 unit. Commercial multifamily real estate is 5 units or greater. So typically we try to buy 5, 10, 20, 100, 300 unit apartment buildings, okay, or complexes. So why buy more? Let's talk about economies of scale. As you buy more, things become cheaper. The cost of the item becomes cheaper to manage. The cost of services like maintenance becomes cheaper as you grow and increase that property unit count. Okay. Let's say you had to replace one roof in a house, but it's probably going to cost pretty similar to 2 or 3 units under that same roof, right? So things become a little bit cheaper as we get the economies of scale growing. Commercial multifamily properties are 5 units and greater, and we want to have as many doors as feasible for us. Doors or units are often referred to as the same thing, or we call them the same thing. They're basically apartments. So we want to have as many doors as possible under one roof so that we can reduce the cost of everything. Also, another reason to have more units is because let's say we had a single family property, and we don't have it occupied, meaning there's no tenant in there. One vacancy is 100% of your income on a single family property. One vacancy on a 100 unit count apartment building is much less. So you can have vacancies on a larger apartment complex and it won't affect your NOI or income rather that much. Cash flow. People pay rent, meaning they're paying the mortgage for you. They're paying down your principal, your mortgage, and you're getting some cash flow above all of that and the expenses of the property. So we often look as apartment investors, we look for NOI. So NOI, net operating income, is income minus expenses before debt. Okay. So if we have positive income after the expenses, typically it's around 40 or 50% expenses. Let's say we make $100,000 in income, $50,000 are expenses are taken out for expenses rather. We have $50,000 left over for cash flow. Sometimes we have to pay $25,000 or so, or $40,000, $30,000, $10,000 for our debt. Okay. And whatever's left over after the debt, we put in our pockets. So let's take that scenario again. Our apartment building is generating $100,000 a month, let's say. $50,000 a month are taken out for the expenses, meaning taxes, insurance, repairs and maintenance, legal costs, property management, lawn care, etc. These are the expenses that go into owning a property. $100,000 in income, $50,000 in expenses, and then we have $25,000 that we have to pay for our debt service. That puts $25,000 in our pocket a month. Pretty cut and dry, pretty great. Now, let's say also we have fixed rate debt, meaning we got a fixed rate mortgage on this apartment. We know that the mortgage is never going to change. This is excellent because as time goes on, we are able to increase rents, typically 1 to 3%. We can increase a year in rents. That means that the more time that goes by, the cheaper that debt becomes and the more we're paying down. So our tenants, our residents at this apartment building are going to be paying our mortgage for us, increasing our equity in this property, and we're going to get to charge them more money as inflation increases. As time goes by and wages increase, we can increase the rents. So we are getting more money if we have fixed rate debt. We're getting more cash flow in our pockets if we have fixed rate debt as time goes on. Also, because property is a tangible, real asset, we as investors have this tangible, real asset as a hedge against inflation. So that's one key benefit to owning real estate as well. Another key benefit is depreciation. There are excellent laws that allow us to depreciate the property quickly. We have something called accelerated depreciation, where we can depreciate the property value more quickly. Let's say we're only going to hold the property for 5 years. That's our business plan. We want to hold the property for 5 or 7 years. We can depreciate basically all of that in 3 to 5 years using accelerated depreciation and cost segregation studies. These are tactics that we use to put more money in our pockets up front as apartment owners. Now, everybody's tax situation is very different, so you have to check in with your tax advisor as to how it will benefit you. If you have passive gains, the depreciation can offset passive income. If you are a business owner, you may be eligible to gain more tax refunds through owning apartment buildings, okay, and getting cash flow. Now, let's talk a little bit about where you should be purchasing properties. So, whoever sent you this podcast has likely done their research and chosen a market or two to invest in. And what kind of research we do is we look for population growth. We look for where people are moving. Okay. If the population in a city is increasing rapidly, maybe 2 to 3% a year, that is huge. That is a telltale sign of the ability to increase rents as well as the ability of a property to appreciate. So we look for where people are moving to. We look for income or wage growth in a market. We also look for job diversity. Okay, so we don't typically look in an area that has only one industry. For example, what happened in Detroit with the car industry, once the car industry left, Detroit went to crap. We don't look for that. We look for multiple types of jobs and businesses that are in one market. So a lot of places are known for being business friendly. What that means is they offer incentives for people to start businesses in that area. That is a wonderful thing. So we look for income growth, job or wage growth. We look for job diversity. We look for population growth. There are other metrics as well, but those are the top ones. Let's talk briefly about how to purchase multifamily real estate. So you're probably thinking, I can't afford to buy an apartment building. However, remember, we're going to be putting debt on it from a bank. They'll typically put down 55 to 75 or 80% of the property's value. They will give you as a loan. And remember, you're going to get it as a fixed rate debt so that over time you're going to be paying off that debt and your rents are increasing only increasing the cash flow over time that you get to keep in your pocket. So we're using leverage to buy these properties, and then the remaining 20 to 45% of the money that needs to be put down is going to come from you and or your partners and or people that you raise money from. So so for people listening who are brand new, some people buy apartment buildings and they do what's called a syndication. So a syndication is where you pool together resources from your friends, family, people that you know to buy something that you typically cannot afford on your own. So let's say there are 10 people and you want to collect $100,000 from each person. Their investment into your property is now $1 million. So you have $1 million to spend on a property. Typically, in a syndication, there are going to be what are called the general partners, managers of the property, which is different than a property manager. These are just managers who manage the asset. And then there are limited partners, LPs, who invest passively in the property and just collect a return. So my typical audience are general partners. They own and operate apartment complexes, and we look for limited partners, our friends, family, close people to invest with us. So what happens is, let's say I were to buy a $5 million property. I need $1 million to put down. I will reach out and share the opportunity to invest in my property with my friends, family, people that I know and love and trust. And they know, love, and trust me. And they've been watching me and watching my journey and watching me acquire apartments throughout the years. So they are looking for an opportunity to get involved so that they can begin investing and getting the benefits of investing in real estate without doing any work, which is the key. As a passive investor, you have the opportunity to just put your money into a property with somebody that you know that is going to operate it properly and give you a return. So, for example, on our properties, we're giving quarterly dividends. It's cash flow that we pay out, and you can do the same. So, here are some typical metrics of what you should be looking for as a brand new investor. Let's say you wanted to get involved. You have $50 or $100,000 that you want to put down into a property and invest to expand your investing portfolio. You might own stocks already. You might have some other investments, but now you're going to invest in a syndication with somebody who knows what they're doing. So typically when we present a deal to people like you, we present an IRR, an internal rate of return. We present an average annual return, the AAR. We present an equity multiple, how much money you're going to get back over time as a multiplier. And we present the cash on cash return. There's different metrics that we present to you. You typically want to look for anywhere from 5 to 8% cash on cash, although it's difficult to really find that. That's why we don't always offer opportunities, even though there are hundreds. I look at hundreds of deals, right? I only acquire maybe 1 out of 100 because they don't fit my criteria of investing needs and they don't fit my investors' needs either. So the IRR is the internal rate of return. We typically look from anywhere from 15 to 20% IRR. And that just an IRR is like a time value of money. So let's say you invested $100,000 today. That $100,000 is gone. You're not looking at it. You're not getting it. So there's a time value to not having that money in your hand. So the quicker you get that money back, the higher the IRR is. Then there's an average annual return. So let's say you gave me $100,000 today, and in 5 years I gave you $200,000. So that is a 2x equity multiple, and the average annual return is 20% because you're getting $20,000 year over year for 5 years, essentially. You don't get that all up front. You get it upon sale. Then there's cash on cash, which is what you're getting monthly. Let's say monthly or quarterly. Let's say I'm paying out for $100,000, 8% cash on cash would be $8,000 a year, equates to about $667,000. I'm sorry, $667 a month if we're going to be paying that out monthly. So imagine that you put down $100,000, you're getting $670 a month, and you're getting appreciation and your property value is going up, and you're able to write off a lot of expenses and taxes. And on top of that, you're paying down the debt, and your delta to own your equity in the property is growing. And that's it, guys. I'm going to keep it very simple today. So for you who are brand new investors, let's remember, recap that investing in large apartment complexes or medium, anywhere from 5 to 100 plus units, is going to give you economies of scale. So the more properties you own, the cheaper it is to own and the more efficient it is. Remember that there is cost segregation studies that we do to accelerate the depreciation and put more money in your pocket upfront. Remember that we are using leverage or debt to buy these properties, and that's fixed rate. So we're using other people's money, our tenants, to pay down that debt and to pay down the principal, increasing our equity in the property, as well as we have the ability to hedge inflation because we have a hard asset. We also have the ability of cash flow increasing because we get to raise rents. So remember, if you are a brand new investor, reach out to whoever sent you this podcast. Have a quick conversation with them to learn little by little what it is to invest in multifamily real estate. And also remember that you can invest passively, meaning as long as you have $50,000 or $100,000 that to invest and you know what you're doing, you can invest in a syndication with the person that sent you this podcast, or me, or anybody that you know that is doing multifamily real estate investing. And once you do, remember, let's say you invest, you now are an apartment owner. That is pretty cool to say. You own an apartment building or a piece of it at least, and you don't have to do any work if you are a limited partner or an LP. If you want to be a general partner and do active multifamily real estate investing like what I do, reach out to me or the person that sent you this podcast and have a conversation to start learning a little bit more. But remember, this is going to take years to really understand and start getting the grips on and start actually investing in. So it really behooves you upfront to start investing as a limited partner or an LP. Okay. Love you guys. Have an awesome day. If you have any more questions, reach out to whoever sent you this podcast or me. All right. And that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.